There are different sources of finance coming in, including debt funds. But I think one general point I'd make is the role of equity is substantially more important. You clearly have to put more equity into deals than you used to. And there are more and more players that are actually quite willing to do all equity deals. We are seeing more and more transactions that are being purchased out of equity, and thereafter they are proposed to be refinanced. But people are willing to take the risk, and at the right yields, all equity transactions are more common than they used to be. That's one point. Secondly, in terms of countries, as I said, I mean, Poland and the Czech Republic, most German banks are active, and if it's up to 55 or 60% LTV, you will find debt at reasonable terms. Hungary, Romania, you probably have to look to the local banks, which are basically the subsidiaries of international banks on that market. And as I said, in places like Russia, you've got the big Russian banks anyway. But for the international cross-border lending that used to sort of dominate the early 2000s, mainly through German lenders, I think it's really down to Poland and Czech Republic only.
And is that everybody else's experience on the panel? Craig, you said that you had something to add on the debt financing side and that.
I think in the logistics centre side, you've seen the major transactions with Panattoni and Prologis in the first half of this year. Sent the Prologis Heinz transaction, they've just financed that at a scale, and that's mainly a Polish portfolio. I think if you took that portfolio to some of the southern markets, it would be difficult to finance. So that's maybe one side of the sector. From a development perspective, again, it comes back to what we were saying earlier, it's basic property principles. It's a good tenant on a good lease. One of the things that we're finding with the banks is they look at the lease, but also who is the actual developer in terms of skills and track record. And who you're bringing in with your partners in terms of the contractor, how you're putting the land together, etc., etc., etc. That's all going through risk committee as a tick box or not. And if you answer all those questions, you can get debt pretty easily for that type of product. Anything that moves away from that, whether it be lease length or a slight locational difference, or the customer doesn't quite give you the guarantee that you need, it becomes more difficult.
We found the debt markets have been relatively active. If you've got the right product in the right location, you can get the term sheets that you require on generally the terms that are available today. And I think that's typically the case in Poland. In the Czech Republic, we did two large transactions over the last sort of 12 to 15 months. One was a 300 million euro logistics transaction, and the other one was a 150 million euro logistics transaction. And both of those we secured debt with from local banks. So the 300 million transaction, we secured over 200 million of debt from a consortium of 4 local banks. And then that consortium went with us when we did the second transaction because it's with the same partner. So you can get debt from a variety of sources, but you just need to be aware the terms they're relatively similar between all the banks. It's not like one's going to be giving you 60% and one's going to be giving you 80, or one's going to be at a margin of 200 and someone's at 400. You know, people are all roughly around the same areas, similar terms. You just work based on relationships from us towards the banks and from the banks towards the equity providers. But we were surprised, to be honest, on the transactions in the Czech Republic, that the local banks were competitive and wanted to be active in that market. And we found them a very appealing consortium to work with. To be honest, it's the first time I've worked with a consortium of 4 banks, and I was very worried that I was going to get the worst terms from every bank, and that was the way it was going to work. But in reality, it was a very smooth process, and it spoke volumes, I think, from both our side as the purchaser and the banks, that we went along and did a second transaction, which obviously was very easy because we just copied the first one. It was interesting because the local banks were more aggressive than the German banks. And I think that was what was interesting for me, was that I hadn't seen that before. Because typically in Poland, you find the German banks provide the better term sheets. They are the more recognised partners. You've got relationships with them in other parts of Europe. And in Czech Republic, we had no pre-existing relationships with those banks. And they had no relationship with us. But it was they wanted to be in that market and wanted to lend. And so we took a chance, and I'm pleased to say it worked out for us. Undeniably, there is less banks to go to today. You can probably, I think if we go out with what we think is a good financeable product, generally in Central Europe, we can probably get probably 3 to 5 term sheets. They may be term sheets for 50%, then you have to pull the banks together to do 100. So, but you can generally find financing. So it's not like you can go out and all of a sudden you've got 15 term sheets and you're picking choose and fighting the banks off from each other. That's just not the way it's working. But if you've got the right product, you can probably get 3 to 5. But that I wouldn't have thought you could get any more. But that 3 to 5 may not be funding 100%. So in reality, that 3 to 5 really might be 3, because it might be one that's pairing up and someone else that was offering the whole investment.